In the first place, I want to greet and congratulate La Bolsa de Comercio de Rosario for this 141st anniversary, so congratulations with that. On the other hand, I also want to thank you for inviting me to this dissertation. It fills me with pride and honor to be here and to be able to talk to you about a topic that I think is important, and that there is a lot of debate today, which is about the volatility of the interest rates. Therefore, the idea that I have today, obviously it will be a talk according to this auditorium, which is a technical auditorium, and I will be explaining how we see the issue of the interest rates. To be able to get to that, I will make a brief review of how we understand the problem of money and prices. After that, we are going to talk about how we see the issue of the exchange rate. Then we will get to the issue of the interest rates. And the last part of the presentation is the application to the Argentine case, and how we are thinking about monetary problems, how we are thinking about the problem of the interest rates in the light of an election year. In this sense, the first thing we are going to point out is that our approach regarding what has to do with money and prices is a true approach to general balance. There are some economists who believe that creating a system of equations as a system of general balance, but not all systems of equations are models of general balance. The fundamental difference between the approach of general balance is that one works with the micro-fundaments. And in that sense, it is vital and important to understand the origin of money. Therefore, the first thing to understand is how an economy without money would be. We have also studied this very strongly, which is what is known as the pure exchange economy, also the barter economy. Now, the problem with the barter economy is that you basically have two great difficulties. And these difficulties are so important that they can end up eliminating exchanges. And that generates a tremendous loss of well-being. The first problem that a barter economy or pure exchange finds is what is called the double coincidence. That is to say, I can want to eat bread and I need a waiter to want an economy conference. That has some difficulty, but let's suppose then that we solve this problem of the double coincidence. That is to say that I want to sell my conference, that someone wants to buy it. That is, I want to buy bread and someone wants to receive a conference in exchange. There is asked the problem of indivisibility, that is, perhaps the amount of kilos of bread that represents a conference would not be viable. There is a problem of indivisibility because the truth is that for a kilo of bread, maybe I tell you, I don't know long life freedom, but then what I mean is that for that problem and indivisibility, or that you suddenly want to buy a car, that is, then, how many conferences and then all the transactions that are lost. Naturally, man did not start to cry because the economy of joy was quite complex. What did he do? He looked for a way to carry out the exchanges. Basically, this is how all the types of money and merchandise appeared. If you remember, for example, the first money that the human being used was cattle. Why? Because he traveled with cattle, the nomadic man. So he used cattle as a currency. Now, when the man became sedentary, he began to use other types of goods that were a better exchange. For example, one of them was wheat, and suddenly it is not because he wanted wheat per se, but because he bought wheat so that with the wheat he could buy other things. This is where indirect exchange goods appears. That is, in the same sense, we have the case of salt. The case of salt is very interesting because, notice, the tradition of not passing the cellar in the hand, and that if the salt falls, it is bad luck. Basically, it is because when you made those transactions, what happened if he manipulated the sack and it fell? You had an instant loss of capital. So it's like, I don't know, you had an action and it fell by 20%. That is, at that moment, nothing more. So clearly, if the salt fell, it was bad luck. And that's where that tradition comes from. Or, for example, those who are about my age or a little older have seen prison movies, and the money is in prison are cigarettes. That is, they are what is then called, as I said before, indirect exchange goods. That is, the goods that are used to make exchanges, not because he wants it per se, and that has a direct consequence. And that is that, in the end, the demand for money is a mere demand of what happens in the goods market. So, for example, you have seen in the text box these functions of money demand, which depend positively on the income and negatively on the interest rate. Now, that formulation of money demand is not of general equilibrium. That formulation of money demand is wrong. In reality, if the demand for money is a mere demand of what happened in the goods market, the real demand for money should be a function of these characteristics. That is, it is a function that basically depends on consumption. That is, the real demand for money depends on consumption. And if you are in a context of general equilibrium, what you have is that consumption is a function of all the economic prices. In short, the demand for money that you are going to have will have these characteristics. That is, where the consumption vector depends on all the economic prices. And then you realize that the function of money demand that depends on the income and depends on the interest rate. Why do I explain this? Because it is fundamental to understand what the interest rate is later. We will see that in the third part. Why in a system of general equilibrium we do not put the income in the function of money demand? Because in a model of true general equilibrium, the income is determined by the equilibrium of prices and quantities. Therefore, putting the income is a bad definition. It would be like duplicating the functional problem. That is, with the prices being there, it reaches and overflows. That is, in the end, your income will be derived from what? From the sale of leisure, plus the participation that you have in the companies of the economy. And in the end, what happens in the benefits of the company of the economy depends on the prices. In the end, it will depend on all the prices if it is more. And I am already telling you that in reality, it is also wrong to put the interest rate in the function of money demand. I explain this because there are some reflections about what the interest rate is, which are aberrant and which are wrong. For example, to say that the interest rate is the price of money. If you listen to an economist say that, I suggest that you invite him to leave in an elegant way. Why? Basically, because in reality, the interest rate does not exist because money exists. The interest rate exists because time exists. You could have a currency economy that has an interest rate, because basically the interest rate has to do with the relationship of the present prices with respect to the future prices. Therefore, the interest rate has to do with the existence of time. Those who are used to looking at models of intertemporal characteristics. If you, for example, looked at the model of Ramsey, I say the model of Ramsey has an interest rate and yet it does not have money. So how does the interest rate appear? Well, I'm going to be explaining that in greater detail in part 3. But it's a preview that I gave you. And what is interesting about this? That if the demand for money has the characteristic that I just made, and the consumption in reality, what will it depend on? It would depend on the structural characteristics of an economy, which are preferences. Preferences are a fact. It would depend on technology. God forbid that you know how technological progress is going to be. It is also a fact. If you have the donations, they are also a fact. And if you assume a private property economy, the benefits are all captured by the private sector. Therefore, all these elements that are here and that are called deep parameters, so Robert Lucas Jr. called them. Basically, if these parameters are all given, it means that unless the system has some disturbance, this consumption vector is given, and in reality it is a granitic form. That is to say that the quantities of theorists, when they assumed that the demand for money was a constant fraction of the income, they were not fools. That is, they were seeing a problem that depended on all the parameters that were exogenous. And then, what does all this come to? Well, this comes at an equilibrium. The real money supply has to be equal to the demand for money, to the real demand for money. And why is this important? Because I can clear up the price level. If the price level is a quotient between the money supply and the demand for money, hence the monetary nature of inflation. That is, inflation is always and everywhere a monetary phenomenon generated by an excess of supply, either because it raises M or because the demand for money falls, or because the two things that cause a price level to rise occur. That is, that the purchasing power of the currency falls. So, in short, that is what explains the monetary nature of inflation. And that, in addition, why is it interesting? Why is it important? Because when we arrive to the government, the inflation rate was running at 1.5 daily. And today the inflation is running at 1.5 monthly. If you put that in exponential times, the inflation rate stopped running from levels of 17,000% to levels of 20%. Now it is understood why Mr. Toto Capusa is the best minister of economy in the world. And that, basically, we achieved by having ended the fiscal deficit in the first month of management. We inherited a fiscal deficit in the GDP's 5-point treasury and 10 points of the GDP in the central bank. So we did in the first month of management what had not done in 123 years, which was to put the financial result in cash. But also something that seemed impossible. At 6 months we cleaned the balance of the central bank. So we began to put an end to the creation of endogenous money, and therefore inflation end to the past to end inflation. Not only that, but also, therefore, the first myth that we dropped was that nonsense of multi-causal inflation. We demonstrated that inflation is a monetary phenomenon. We cut the emission of money and inflation was cut. Now, it is also true that when we begin to do this, they said that it was not going to work, that we were not going to be able to lower inflation by levels of 30% per month. When inflation dropped, then they said that we could not break the 8. Then we could break the 4, then we could break the 2, and inflation continues to drop. In fact, inflation does not happen instantly. That is something that politicians like. Why? Because you inject money today, and the impact appears within 18 to 24 months later, between a year and a half and 2. So that's why it's so fun for them. They vote for any kind of nonsense to increase public spending and generate tax deficit. If, in the end, another salami pays for it 2 years later, and in that context, we have been able to fix the amount of money since the middle of last year. Therefore, from here to the middle of next year, inflation will have been just a nightmare that ended. And in that context, not only that, they said that economic activity was going to collapse, that we were going to cause a Great Depression, and that did not happen. The activity measured by the EMA is just stationed. December against December ended up 6% growth. That is, the economy collapsed during the first quarter, and from April it began to expand. Therefore, we have already been 5 quarters with the economy expanding. We have already reached the maximum level we had in 2011, and we are also at the peak of consumption. To say that all those things they say about that activity does not recover, that consumption is depressed, is a long story because the data says something else. But things also happened in the middle. That strong recovery from the activity and the fall in inflation made that since the month of April last year, the real wages have also increased continuously. And that has meant to the core liberals, take 12 million people out of poverty, 6 million people who did not eat steady eat, and we also take 2.5 million children out of poverty. Therefore, clearly the cities of freedom are working. But we have not only managed to throw away all those myths. That is, we have managed to show that a fiscal adjustment is expansive. That is, what is basically the transfer to devaluation prices. Something like, if you wanted, you would have to go from the type of change to the prices. And we said no, that this was false, and that in reality the cause is from the amount of money to the prices. What happens is that literature, as a consequence of what was a Keynesianism, ignores something called the Hume-Cantillon effect. The Hume-Cantillon effect, what it does is describe the dynamics that the prices are having. So, when you generate in excess of money, as we said before, or because we emit money, or because the demand fell, or because both things happened at the same time, what happens is that, as the exchange rate is a dollar, it is a financial asset, it rises first. Behind the rise in the dollar comes the rise in the transferable. Then come the wholesale, then the consumer, and finally the salaried. That is why devaluations are so unpopular, because it basically implies the destruction of the real wage. That is why sometimes I'm surprised by those who are all the time asking for devaluation, because the one who is asking for devaluation all the time is asking for the lower wages in dollars and for the increase in the poor and the needy. Excuse me, but I'll pass on that model. In fact, the economists do not work well with the general equilibrium models. So what we have to understand is why sometimes devaluation generates inflation and why sometimes it does not. And that clearly depends on the humanitarian evaluation. Suppose I have two assets and B, and the question is, does the demand of A rise? And does the demand of B fall? That means that the price of A has to rise, and the price of B has to fall. That is, the relative price between A and B rises. Now, in that context, if I continue to consume in an elastic way, my expense N will increase. Consequently, my expense in B has to fall. That is, as the price of A raises, there will be a retraction of the demand in B, which is what will push the price down. The only way that the price of B does not fall is that I extend the budget restriction to individuals. And the way in which a government does that is by issuing money. So when you extend the budget restriction to the individual, I mean so that he spends more, the consequence is that the price of B does not fall, much more than proportionally. And if you take into account that, in addition, monetary policy has lags, it may be that even monetary consolidation has occurred many times before, because you have to wait between 18 and 24 months until inflation disappears. In fact, today, what we are doing is purging the inflation that the previous government left us. In the course of 4 years, it issued 28 points of the GDP, which during the last year of management, order management, issued 13 points of the GDP. And in that context, the problems appear not only of the traditional or common retraction from 18 to 24 months. Two figures appear, or a same figure, but with different origins, which is the problem of the money overhand monetary, that is, the surplus of money. For example, one of the things that happens is that if you fix prices, what they are doing, setting prices below the balance, which is what is usually done recurrently, not only generates excess demand in the goods market, generates an excess of artificial supply in the money market. That is, there is the surplus of money, and it is because of the purchasing power of money is the inverse of the price level. If you implement price controls, it is like putting a price above the balance of money. Consequently, when they implement price controls, they generate a surplus of money. Obviously, when you release it, one of the things that happens is that the prices go in place as a leap in the price level that appears as inflation. We suffer from it. In the first month of government, that is a leap of 54% in the wholesale prices and 25% in the consumer price. But it is not the only source of surplus of money. There is another source of surplus of money that derives from capital controls. That is, there is surplus of money. 3 capital controls. If you, for example, have a tax deficit, as the previous government had, and it issued to mansover, that generated pressure on prices. As the previous government did not want to recognize that, it not only implemented price controls, but also when demand began to escape to the market of chanceable goods. What was the consequence? The consequence is that we began to deteriorate the accounts of the external sector, and by not having financing, that generated a current account deficit. Then they began to lose dollars. So what did the previous government do? It implemented capital controls, which is a way of evaluating without touching the exchange rate, which is a savings going against the quantities. Obviously, that generated an excess, a supply in the stock market that made the price of bonds drop, and therefore the interest rate rise, and the country's risk was enormous. The country's risk was around 3,000 basic points. The high interest rate generated an excess of supply in the stock market. Therefore, the activity was stagnant. Since 2011 in Argentina, with fluctuations according to the political cycle, not only that the excess supply in the stock market was translated into an excess supply in the labor market, which not only made the real wage drop, but also did not generate jobs that the previous government compensated and generated a larger tax deficit. We came to the madness that a third of the former workers were poor. That was a system they left. Obviously, we are still purging all these monetary imbalances left by the capitalism, and that we, having set the amount of money in the middle of last year, we estimate that in the middle of next year, there will be no more inflation. In fact, it is very interesting because I'm surprised that economists do not even realize that the Hume-Cantillon effect is in a model that they usually talk a lot, and that, in fact, they mention it all the time, that it is the model of Dornbusch overshooting, a paper that he wrote in 1976. It was so advanced and so revolutionary for the time that he had to publish in a third-rate journal, because when the papers are very novel, they do not easily enter the important journals, and in fact, the overshooting explains a situation in which there is an exaggerated jump in the exchange rate and then it falls. Basically, what you have is that you generate the monetary imbalance equal to the exchange market. And since there are not enough dollars, the exchange rate rises, and he has to devalue more than proportionally, because since the goods market adjusts slowly, you have to over-devalue, so that imports fall a loss and so the exports rise, and thus balance in the financial market the generation that you have to generate in the goods market. In other words, overshooting is a consequence that the money market adjusts quickly and that the goods market adjusts slowly. That is to say, with which they talk about overshooting, and they do not know the fact of, well,
pasaron algunas cosas interesantes en el medio, ¿no? Porque abrimos el cepo, primero que decían que no lo íbamos a abrir porque era un año electoral. Y la realidad es que
and the reality is that we do not negotiate freedom. So when the dollars were to be open, we do not have a utilitarian criterion. We have a moral criterion. And in that criterion, there is nothing that justifies slavery. And that is why, despite all the forecasts, we opened the sepulchre in an electoral year. Not only that, when the bans were announced, everyone said that they were going to go to the roof of the band, that they were going to break the band. And in reality, almost as if the sensitivities were unity, the price was in the middle. So the reality, if you want, they had the currency market with these characteristics. Here they had the official, here they had the parallel. I say, what would the economic theory have told you? That they were going to go this way? And what happened? They went this way. Obviously, again, they won with good economic theory. But not only that, recently, where a movement in the exchange rate, and there was no transfer to prices. In fact, core inflation continued to fall. That is, not only that core inflation, which has already accumulated for months, coming below 2%, despite the jump in the exchange rate. Core inflation fell. That is, with which we, with the Minister Capito, we have gotten used to them misinterpreting the things we do, because basically they will have to be writing all the manuals, because all the things we have thought during the last 90 years are all wrong. We are showing why, and in that context. The other problem there is the interest rate. The interest rate. In reality, the problem with the misinterpretation of the interest rate has its origin in a book that was published in 1936 by a man called John Maynard Keynes, who wrote a book called General Theory of Occupation of Interest and Money. And basically, it is a model that, unlike the Wixo tradition, which was what predominated economic thinking in the 20th century, if it was of an intertemporal characteristic, Keynes decided to do a job that broke the entire intertemporality of the model. So, while in the Wixo models, the interest rate is determined in the goods market, which I am now going to explain in more detail, and the money acquisition power is determined in the money market. Keynes decides to determine the income in the goods market, that is the GDP. In the labor market, he determines the salary by combining a rigid labor offer and the labor demand linked to the added demand. And in the money market, the interest rate is determined instead of determining the money acquisition power. Therefore, it ends up generating a monster to determine the level of prices, in total contradiction to what economic theory had been working on since 1871 in Menger, but also in parallel with Evans and Bowery, the subjective value theory. Keynes returns to the objective value theory and says that prices are a markup over costs. I mean, the general theory is loved by politicians because everything good that happens in the model is thanks to politics, and all the bad things have someone to blame. That is why Keynesianism is so popular among politicians. We have been doing Keynesianism for a long time, and that is why we must be one of the richest countries in the world. When we arrived, we were at the edge of collapse, and we combined the imbalance of the three worst crises in the history of Argentina, because we combined the monetary imbalance prior to Rodriguez, a balance of the central bank question, the one that Alphonsus Hyper had in the previous one, and social conditions that were worse than that of 2001. That is, they were the sum of all the bad things. So Keynesianism was not good for us. The reality is that no one is doing well. Keynesianism is only useful for populist politicians, demagogues, spendthrists, maniacs, and others, but not for people. So the key is to return to the subject of what the interest rate is. And the interest rate is the relative price of the present goods compared to the future goods. That is, you are not given the same thing to consume today as to consume tomorrow. That is, clearly, let's say tomorrow. Tomorrow is uncertain. You do not know what is going to happen. Consequently, if you are given to choose to consume today, to consume tomorrow, and that relationship between the present price and the future price is the interest rate. So you have now seen that. Regularly one says that when the interest rate rises, the savings increases. And that makes sense, because if you have present goods and future goods, if the price of the present goods rises, That is, the interest rate rises. He substitutes the present goods for the future goods. Therefore, the high interest rate, the high future consumption, that is, the high savings. Hence the functional relationship between savings and interest rate. Now let's suppose the case of a company. A company can sell in the present or can sell in the future. If one believes that the future goods are going to be more expensive, what do? That is, in a situation where the interest rate drops, they are going to pass today's production to the future. That is, as the interest rate drops, the investment will increase. And that interaction between savings and investment is what determines the interest rate. And the interest rate is neither more nor less in the present prices with respect to future goods. So why do I tell all this? Today I was attacked by giving a class on Wixel economy. No, this is very important. I am going to put it like this so that it looks easier. And we are going to do it interactively. Suppose I have an economy of 2 periods, and I have today's price and tomorrow's price. I ask you a question. If tomorrow we are facing the end of the world, that is, we are in a situation of the end of the world, that is, tomorrow the world disappears, would you send consumption to the future? They are not convinced. I don't want to hear them convinced. No one would send consumption to the future if the world were to disappear. Therefore, in the scenario, as the end of the world tomorrow, the future prices are zero. Consequently, the interest rate is insolent. Let's say this flies, and this tends to zero. Therefore, the interest rate tends to infinity. Well, now I am going to tell you the case of a country in South America, well in the south, which is called Argentina, and which has 2 types of politicians. They have those who embrace the ideas of freedom and reasonable people, and on the other side they have the orcs. That is, the cucas. That is where, for example, explicitly a Kirchnerist deputy says, what is my government program? My government program is to break everything that this government does. Well, they have a candidate in the province of Buenos Aires. He says that each one, according to their needs, and from each one, according to their capabilities. That is, he is reciting Marx. Because the truth is that socialism, in its pure version, was always a failure in the economic, in the social, in the cultural, and it also killed 150 million human beings, with which, that model at least, I did not like. Therefore, if you find that in front of the sodomites of capital, they so openly come to say that they are going to break the property rights and therefore they are going to destroy capital, how much do you think the interest rate is worth there? That is obviously, it is like the end of the world scenario. The natural consequence then, when you find yourself in front of an electoral scenario like the one that comes in October, and I would also say September 7, It is clear that the interest rate has to go to the clouds. Why? Because they are on the other side of the sodomites of capital. They are the orcas, they are the jukers, and that is the reality. And that is why the interest rate rises. That is, as Dr. Sturzenegger put it very well, the risk is the risk of the kickers. So in that sense, we have to understand what we have in the face of the future in the light of the election year. And this is interesting because the cukers in the election that will be on September 7 will represent the electoral roof. Why? First, because they vote with a different ballot. Because they also throw away all the equipment to allow fraud, whether it is photocadena and embarazada, or of course to pay cashiers so that they buy scores and stay with all the votes. In addition, the moral fraud that implies putting testimonial candidates who also have the face of admitting that they're going to be testimonial. And this is also a district election. Consequently, where the intendant will be defending their business. If you take them to October, the intendants will not be defending their business. There will be a different system. A voting and national management will also be validated. In short, it is a roof for Kirchnerism. Of course, for us, the advanced freedom is a flow. And if we get to the situation that on September 7, we make a double election, or we win by one vote, it will imply putting the last nail to the coffin of Kirchnerism. That said, it is only now that we see a theoretical scheme to understand what has been happening in the monetary market lately. The first thing I want to do is a small digression about the exchange, so that the graph that I'm going to make is better understood. Basically, if we think in terms of quantitative theory, we would have this situation that the demand for money is a fraction of the GDP, and that would imply that the price level is the amount of money divided by the demand for money. And this could also be valid in the world. Okay. That said, the exchange will come from the relationship between the prices, where the local prices are the exchange for the international price. Or, in other words, the exchange is a level of local price over the international price. And with this, what I can do is replace the international price with the local price. So, this will be determined by what are called the relative monetary conditions, or what is the same. Now, if I assume that the international price is 1, then the exchange will be the same as a local price and will be determined in this way, which is the offer of money with respect to the demand of money. This is similar to what we saw at the beginning, and it is fundamental now to understand how we think about monetary policy. So now I'm going to take probably at some point You will have seen this relationship between what is the exchange and the nominal interest rate. This is interesting because in this way, in the measure that the interest rate decreases, you will find that the exchange increases. It is almost a natural movement that at higher interest rates, the exchange rate decreases, or that at low interest rates, the exchange rate increases. That is, it is a natural result where this line represents the combinations of the exchange and interest rates that leaves a monetary market in balance. As opposed in another way, because we saw it just now, the amount of money offered or the demand of money. This is what happens. The problems when they flourish, they basically flourish when you are in situations where the exchange rate increases. When that happens, it is because you have an excess of money. That excess of money can happen either because the demand fell or because offer fell. So, and that is what we are living in this moment. Basically, in the presence of the QCAS and in an election year, investors are scared. And when they are scared, what do? They did not fully renew the lockups. We, as a central bank, honored the debt and paid. What was the consequence? It generated an expansion of the amount of money, and if the interest rate did not move, everything would go to the exchange rate. Why? Because there was monetary validation. However, what did we decide to do? Maintain the balance of the monetary market. That is to return to the original situation. And what did we do for that? Just as we had to expand the amount of money to honor the debt, that is, we increased the demand for money, or strictly speaking, the demand for monetary base, by leaving the amount of money constant. You will come across this. Then, the balance in the monetary market is fixed. The strategy of deflation remains. And what is the consequence of this? That interest rate rises. But what you are seeing in times of the interest rate rise has to do with an electoral risk, because on the other side are the QCAS. So prior to a scenario like the end of the world, which is what Kirchnerism proposes, where, for example, in a session, many projects are against. What did they intend from the interest rate? That is, thank goodness we cleaned the levies, because you can imagine what it would have been. 16 billion pesos on the street without counterfeit. That is, they would have started over with the pachacos. Well, what we did was suggest the monetary market an electoral year, where the opposition proposes the end of the world. Faced with that situation, if the debt does not roll us, what do? We increase the interest rates. We increase the demand for a monetary basis. Of course, what is the consequence? It is that there is less money in the market. So, when you go to want to get funding, it is more expensive. Yes, of course. Is the activity going to slow down? Of course. Because in the alternative case, not only are they going to interest rates, they're going to go to the cloud, because the jump of the exchange rate is going to have monetary validation, and the nominal interest rates are going to go to the stratosphere. But they are also going to break the monetary balance. They are going to break the exchange rate. We are going to see inflation. And if we do that, we are going to bring the QCAS back. I say, and if there is something that we are clear on, it is that we will never do it again.
Por lo tanto, ¿qué es lo que viene?
Therefore, what comes next?
Nosotros,
We are
a
like
diferencia de la política
traditional
tradicional,
politics,
hemos
have also
decidido
decided
romper
to
la
break that hypothesis
del ciclo
of the political cycle of economic politics.
O sea,
In other words, we have
hemos
decided
decidido entrar al año electoral
to enter the election
con
year
ortodoxia fiscal, con mayor
with a greater fiscal orthodoxy,
porque es lo que
with a greater monetary orthodoxy,
corre al estado del medio,
because it is what has truly proven
pasarse,
that it runs to the middle ground,
redunda en beneficios.
that it lets the private sector express itself, and that reduces benefits. Obviously, in the middle of the electoral juncture, having the kickers in front,
El santo es que subió la caución.
yes, the interest rate is going to be higher.
Tasa relevante.
This is not the relevant rate for the economy.
Digamos, la tasa
The relevant rate for the economy
tasas que son más largas, ¿no?
are rates that are longer, not one-day rates.
Tasas largas
And the long rates did not rise much either.
electoral, los
And in the
inversores
face of an election year,
invertir
investors do not want to invest
hasta que no se despeje el horizonte.
until the electoral horizon is cleared,
Tiene sentido.
which makes
Tiene
sense,
sentido porque lo que está pasando
because what is happening,
es que nos está proponiendo
that is proposing to us
económico y es
from the economic analysis,
argentinos está en
is that the future of Argentinians
Si los
is in the hand of Argentinians.
populismo salvaje,
If the Argentinians want to return to wild populism,
digamos,
okay,
está la sociedad si elige suicidarse,
society, if it chooses to commit suicide,
puede
it chooses to commit suicide,
las ideas de la libertad
but it can also choose to embrace the ideas of freedom.
y pasar
And after the electoral process, there will be a drop in the interest rate. The economic activity will recover, inflation will disappear, and we will enter the path that will make Argentina great again.
Yo creo que es un mensaje esperanzador.
I think it is a hopeful message,
Está en
because
nuestras
today the
manos.
future is in our hands.
Los argentinos de bien
That is, the Argentinians will win,
a los
the
degenerados,
degenerates, the sodomites of the capital, and October will be the beginning
el puntapié de
at the golden century of Argentina.
Muchísimas
Thank you all
gracias.
very much. May God bless you.
Que la fuerza del cielo
May
nos
the forces of
acompañe.
heaven be
¡Y
with
viva la
us.
libertad, carajo!
And none life, freedom, cardio.